Looking to turn your spare cash into something big? With just $25 a week, you could be on your way to building a portfolio worth over $500,000 and earning $5,000 in monthly dividends. Sounds like a dream, right? But it's absolutely possible, and I'm here to show you how. Stick around because I'll be breaking down a simple investment strategy, sharing pro tips to maximize your returns, and even giving you a list of stocks to consider for your portfolio. So, grab that $25 and let's get started. When it comes to building wealth, winging it won't get you very far. Think about it. Would you start a road trip without a map or GPS? Probably not. The same principle applies to financial success. You need a clear plan and strategy to achieve your goals. For most people, the ultimate goal is financial independence, where you can retire comfortably and still enjoy a steady income as if you never stopped working. The key is to start small, stay consistent, and leverage the power of smart investing. Let's face it, life can feel financially tight, and $25 a week might not seem like much. But when you have the right plan, even small amounts can snowball into something massive. That's why having a strategy like DRIP, Dividend Reinvestment Plan, is so critical. It's not just about saving, it's about making your money work for you, growing steadily over time. Here's the beauty of planning. It keeps you focused. You set a goal, break it into manageable steps, and execute consistently. With the right strategy, $25 a week transforms from spare change into a portfolio that can fund your dreams. Financial success isn't just for the wealthy. It's for anyone with the discipline to plan and commit. A dividend reinvestment plan, or DRIP, is one of the smartest strategies for growing your wealth over time. Think of it as planting a financial seed that grows into a massive tree, providing shade and fruit for years to come. With DRIP, instead of pocketing the cash dividends your stocks generate, you automatically reinvest those dividends to buy more shares. This creates a powerful cycle. More shares lead to more dividends, and more dividends buy even more shares. Over time, this snowball effect can turn small, consistent investments into significant wealth. One reason DRIP works so well is compound interest. Reinvesting your earnings means you're not just making money on your initial investment, you're making money on your money. It's like stacking bricks. Each new dividend reinvestment builds a stronger financial foundation. Another advantage of DRIP is that it removes the guesswork of market timing. Instead of stressing about whether to buy stocks when prices are high or low, DRIP allows you to purchase shares regularly. This strategy, called dollar cost averaging, smooths out market fluctuations, making your portfolio more stable over time. Ultimately, DRIP isn't just an investment strategy. It's a long-term wealth-building machine that works quietly and consistently in the background, helping you achieve your financial goals. The Dividend Reinvestment Plan DRIP isn't just a strategy, it's a game-changer for building long-term wealth. One of its greatest advantages is its ability to harness the power of compound interest. When you reinvest your dividends, those earnings are used to purchase additional shares, which then generate even more dividends. This compounding effect can lead to exponential growth over time. Imagine a snowball rolling downhill, growing larger with every turn. That's your portfolio on DRIP. The longer you stay invested, the faster your wealth can grow. Another significant benefit of DRIP is dollar cost averaging, DCA. A simple yet highly effective investment technique. With DCA, you invest a fixed amount regularly, regardless of market conditions. When stock prices are high, you buy fewer shares. When prices are low, you buy more. This approach smooths out the highs and lows of market volatility, ensuring you don't overpay for shares. It's like spreading your risk across time, reducing the impact of bad timing and helping your portfolio stay balanced. DRIP also offers incredible convenience and consistency. Once you set it up, your dividends are automatically reinvested. You don't need to stress about market trends or manual reinvestments. It's all handled for you, allowing you to focus on your long-term goals while your investments quietly grow in the background. While a basic DRIP strategy can work wonders, you can supercharge it by adding a consistent investment schedule and increasing your contributions over time. This approach accelerates the growth of your portfolio and helps you take full advantage of compounding and dollar cost averaging. By committing to invest even a modest amount, like $25 per week or $100 per month, you inject fresh capital into your portfolio, allowing you to purchase additional shares regularly. This not only amplifies the compounding effect, but also builds momentum, ensuring your portfolio grows faster. Think about it. With every extra dollar you contribute, you're buying more shares that generate dividends, which then buy even more shares. Over time, this creates a financial flywheel effect, where your portfolio's growth takes on a life of its own. Adding to your investment during market dips can be especially powerful, as you acquire more shares at lower prices, setting yourself up for even greater returns when the market rebounds. It's also important to periodically review your contributions. As your income grows, consider increasing your weekly or monthly investment amounts. For example, bumping your weekly investment from $25 to $35 may not feel like a huge leap, but over decades it can mean the difference of hundreds of thousands of dollars in portfolio value. By combining DRIP with regular contributions and a disciplined mindset, you're not just passively growing wealth, you're actively building a financial legacy. This small but consistent effort today can yield extraordinary rewards in the future. Choosing the right stocks is the cornerstone of a successful DRIP strategy. Not all dividend-paying stocks are created equal, and selecting the wrong ones can slow down your financial progress. To maximize your returns and ensure long-term growth, focus on stocks with a strong history of dividend payments, financial stability, and consistent growth. Let's break it down into 4 key categories to consider. Blue-chip dividend stocks. These are the giants of the stock market, companies with a long history of stability and reliable dividend payouts. Think household names like Coca-Cola, Procter & Gamble, and Johnson & Johnson. They form the backbone of a strong portfolio, offering steady growth and resilience during economic downturns. Dividend aristocrats. These are elite companies that have increased their dividends for at least 25 consecutive years. They demonstrate a strong commitment to rewarding shareholders, even during challenging market conditions. Examples include Walmart, AT&T, and ExxonMobil. They're perfect for providing stability and consistent income over time. High-yield dividend stocks. If you're looking to boost income, consider stocks with above-average dividend yields. Companies like Verizon and Realty Income Corporation offer attractive returns but may carry slightly higher risk. Growth-oriented dividend stocks. These combine dividend income with capital appreciation. Technology leaders like Microsoft, Apple, and Visa are examples of companies that consistently grow their dividends while offering significant share price appreciation. By blending these categories, you create a diversified portfolio that balances risk, income, and growth potential. When selecting stocks, look for metrics like payout ratios, dividend growth rates, and financial health to ensure you're choosing companies that can sustain and grow their payouts for decades to come. A thoughtful approach to stock selection sets the stage for a portfolio that delivers consistent long-term results. Now, let's see how this plays out. If John invests $25 a week into this portfolio, here's what happens. By year 10, John's portfolio grows to $27,825. By year 20, it reaches $145,500. By year 30, it's worth $823,000, generating $5,280 per month in dividends. With just $25 a week, you can build a financial future that's secure, steady, and stress-free. The DRIP strategy makes it simple, and by choosing the right stocks and staying consistent, you're setting yourself up for long-term success. So, what are you waiting for? Start today. Your future self will thank you. Want to learn how to build your own portfolio? Watch the next video on my channel. Don't forget to like, subscribe, and share this video with someone who needs to hear this. Let's grow our wealth together.